Welcome to this educational video on how the financial world protects itself and its investors. Have you ever wondered what happens behind the scenes to make sure every trade is completed safely, even if a broker fails? Today, we are diving deep into the risk management and settlement framework specifically for the currency derivatives segment to understand the rules that keep our market stable. To start our journey, let's look at the backbone of the clearing corporation. Its primary job is to provide a settlement guarantee, ensuring that money and securities reach their rightful owners even if a member defaults. To do this, it uses a high-tech system for real-time monitoring of margins against liquid assets and alert system that warns members when they use too much collateral and strict risk controls. Like the risk reduction mode, building on that foundation, we need to understand how margins are computed. Margining is simply a way to calculate the potential loss on open positions to ensure there is enough cash or collateral to cover those risks. For individual clients, positions are netted for each person but then added up together at the member level without any offsetting between different clients. For proprietary trades, which are the broker's own trades, the rules are kept separate to ensure no one is using client money for their own risks. Now that we understand the basic principles, let's see how the SPAN system calculates the initial margin. This system takes all of your futures and options and looks at a worst case scenario using 16 different what if situations. It looks at the price scan range like 1.50% for the USD INR pair and the volatility scan range based on a specialized calculation called EWMA. All of this is done to cover the risk with 99% confidence over a one-day horizon, also known as VAR. In addition to those calculations, we also look at the net option value and calendar spreads. The net option value is basically the difference between your long and short option positions based on the closing price. And this amount is added to your liquid net worth for those who use calendar spreads to hedge by holding positions in different months. There are specific charges such as 500 rupees for a 1-month spread in the USD INR pair. While initial margins cover normal market moves, the extreme loss margin or ELM acts as an extra safety net. For wilder market swings, for the USD INR pair, the ELM is 0.50% for futures and 0.75% for options. While futures are calculated based on the market value of the trades, option calculations are based on the total notional value of short positions using the FBIL reference rate. To support all these margins, members must maintain liquid assets and a healthy liquid net worth. These assets are split into two categories: a cash component, which must be at least 50% of the total, and a non-cash component. To be safe, the clearing corporation applies a haircut, which is a small percentage reduction in the value of the collateral. For example, liquid mutual funds have a 10% haircut, while government securities with less than 3 years left have a 2% haircut. Now let's discuss what happens when a broker uses too much of their collateral through the risk reduction mode protocols. If a broker uses 90% of their available collateral, a trigger is pulled that cancels all their unexecuted orders. In this mode, they can only place orders that reduce their risk, and they can only return to normal trading once their utilization drops below 85%. Connecting the brokers to the clients, we have the margin collection and penalty mechanisms. Brokers must collect all initial and extreme loss margins from clients upfront before the trade even happens. If they fail to report this correctly by the deadline of T+5 days, it is treated as a total failure to collect. And false reporting can even lead to a one-day trading suspension and a penalty of 100% of the amount. The investor, there is a strict client collateral protection mechanism. Gone are the days of title transfers where you just handed over your securities. Now we use a system called margin pledge through depositories like NSDL and CDSL. This creates a clear repledge chain from the client to the TM, then the CM, and finally the clearing corporation, providing a full audit trail so you can see your collateral status at every level. Now, even with all these margins, the market keeps a massive rainy day fund called the Core Settlement Guarantee Fund, or SGF. This fund is there to guarantee settlement. Even if a large member fails, it is funded by the clearing corporation, which provides at least 50%, the stock exchange with 25%, and the clearing members who contribute the remaining 25%. This corpus is reviewed every month using daily stress tests to make sure it is big enough. But how exactly is that fund used? If someone defaults, we follow a very specific default waterfall structure. First, we use the money of the person who defaulted. If that is not enough, we look to insurance, and then a small portion of the clearing corporation's own resources. Only after those are exhausted do we touch the core SGF, starting with penalties and moving through the contributions of the institutions and non-defaulting members. Moving from safety funds to the actual daily operations, let's look at settlement mechanics and pricing. Daily mark-to-market settlement happens on a T+1 basis, meaning the profit or loss is settled the next day in cash. For the final settlement, when a contract expires, it happens on a T+2 basis using the official FBIL reference rate from the last trading day. Even for cross-currency trades, everything is ultimately settled in Indian rupees. Building on that, the fund settlement and running accounts rules ensure your cash is always handled properly. All money moves through primary clearing accounts at designated banks, and any shortage can lead to a broker losing their trading rights. There is also a very important 30-day dormancy rule. If you do not trade for 30 calendar days, your broker must return your entire credit balance to you. Finally, we must address the modern world of digital threats through the Cybersecurity and Resilience Framework, or CSCRF. This framework is mandatory for all market infrastructure institutions to protect the integrity of your data. It focuses on 5 key goals: anticipating attacks, withstanding them if they happen, containing the crisis, recovering your functions, and evolving to prevent future threats. Together, all these rules and systems create a safe environment for you to trade with confidence